Savings accounts. A savings account is often the first place people begin. You deposit money into a bank, and the bank pays you a small amount of interest over time for keeping it there. It is one of the safest forms of investing because your money is usually protected by government backed insurance up to certain limits. The trade off is simple safety comes with slower growth. Savings accounts are less about building wealth quickly and more about protecting cash, emergency funds, or money you may need soon. Certificates of deposit, often called CDs, are a step beyond regular savings. You agree to leave your money with a bank for a fixed period, such as 6 months or 5 years, and in return, the bank usually offers a higher interest rate. The longer you lock it away, the better the return may be. These became especially popular for conservative investors who wanted predictable growth without stock market risk. The downside is reduced flexibility, since withdrawing early often comes with penalties. Bonds. Bonds are essentially loans made by investors to governments or companies. When you buy a bond, you are lending money in exchange for regular interest payments and the return of your original amount later. Governments have used bonds for centuries to fund wars, roads, and national projects, while companies use them to expand operations. Bonds are generally considered steadier than stocks, though not risk-free. Their appeal comes from income and relative stability. Stocks. Stocks represent ownership in a company. When you buy a share, you own a small piece of that business and may benefit if it grows. Modern stock markets made it possible for ordinary people to invest in major industries, from technology to healthcare. Stocks can rise dramatically, but they can also fall just as fast. What makes them powerful is long-term growth potential, especially when companies expand, innovate, or dominate their industries. Dividend stocks. Dividend stocks are shares in companies that regularly distribute part of their profits to investors. These are often established businesses with steady earnings, such as utilities, banks, or consumer goods companies. For many investors, dividends create a stream of passive income while still allowing ownership growth. They became especially attractive for those seeking both stability and returns, combining stock market participation with cash flow. Mutual funds. Mutual funds pool money from many investors and use it to buy a broad collection of assets. A professional manager decides what to purchase, whether stocks, bonds, or both. This structure made diversification easier for everyday people who could not build large portfolios alone. Mutual funds can reduce individual risk through variety, though management fees may affect returns. They are often chosen for convenience and professional oversight. Index funds. Index funds are designed to mirror the performance of a market index, such as the S&P 500. Instead of trying to beat the market, they simply aim to match it. This passive approach became increasingly popular because of its lower fees and long-term efficiency. For many investors, index funds offer broad diversification, simplicity, and historically strong results over time. They are often considered one of the most practical modern investment tools. Exchange-traded funds. Exchange-traded funds, or ETFs, work similarly to mutual funds, but trade on stock exchanges like individual stocks. This gives investors flexibility to buy and sell throughout the day. ETFs can track markets, sectors, commodities, or even specific strategies. Their growth reflects the demand for low-cost diversification combined with easy access. They are now widely used by both beginners and experienced investors.